This is Professor Russell James coming to you from Texas Tech University. Welcome to today's lecture from Visual Plan Giving, an introduction to the law and taxation of charitable gift planning. Welcome to Valuing Gifts of Property, Part 3, Special Assets. This is Professor Russell James. From time to time, there have been special kinds of property that have been used in significant tax abuses. As a result, Congress has acted to create special rules that apply only to specific types of property, usually in response to these tax abuses. For these special kinds of property, the normal rules are modified. Special charitable donation rules apply to clothing, household items, cars, boats, airplanes, taxidermy, inventory, patents, and other intellectual property. Considering the complexity of the standard rules that we have already reviewed in previous lectures, why would Congress add these special rules for specific assets? The answer is that Congress reacted to ongoing abuses that fit the normal rules but were still considered to be inappropriate. There is always a special potential for abuse in the area of deductions for gifts of property where the property has an uncertain valuation. Consider that if a taxpayer was at the top federal tax rate of 39.6% and the top state tax rate in a state like California where the top rate is 13.3%, that a deduction is worth nearly half of the value of the gifted property, even when the federal deduction for state taxes is fully usable. When a property is difficult to value or difficult to sell, but can be immediately converted into a tax benefit worth nearly 50 cents of every appraised dollar, it can make such transfers highly attractive, even to those with little or no charitable intent. If a difficult-to-value item of property can be appraised for 2 or 3 times what it could actually be sold for in an immediate sale, it may be more profitable to donate the property rather than to sell it. Such financial incentives make gifts of difficult-to-value assets ripe for abuse. What do the abuses that led to special rules look like? For example, a person might have old clothes that she would otherwise throw in the trash because they have little or no resale value. But instead of throwing them away, the person could give them away and generate a charitable deduction. Perhaps the person may attempt to value the deduction based on the original cost of the clothing or some, quote, estimated value based on a percentage of the original cost, when in reality the poor quality clothing has little or no resale value. Another abuse could result from gifts of automobiles, where the automobile has some defect that reduces its value below the normal resale value for that model and year of car. Even though in reality the automobile may be worth nothing except in a junkyard, taxpayers may be tempted to donate the vehicle and deduct the standard value for a vehicle of that age, make, and model. In other words, the Blue Book value. A particularly egregious abuse occurred in the area of donating stuffed animals to a wildlife museum. In this scheme, the taxpayer would go on a safari to hunt exotic animals, have the animals stuffed, and then donate the animals to a wildlife museum. An appraisal firm would provide a high valuation for exotic stuffed animals, a valuation which might be difficult to disprove given the rarity of transactions and the high cost of acquiring new exotic stuffed animals. A few small wildlife museums were willing to accept these donations, often taking in thousands of animals. The donor would then deduct his cost basis in the stuffed animal, including all of the costs of acquiring the animal, such as the entire expense of the safari travel. Thus, the tax code was essentially funding a substantial portion of safari tourism intended to kill exotic animals. A different problem arose with copyrights and other intellectual property, not simply because of the risk of fraud, but also because of the enormous difficulty in valuing such intellectual property in advance. If a best-selling author like John Grisham wrote a new book and immediately donated the copyright of the book to charity, such a donation would be enormously valuable. If a less well-known author did the same, the donation could be highly valuable, and it could be worth nothing. The difficulty is that it may be impossible to tell at the time of the donation how much the gift is worth. No amount of sophistication, education, experience, or integrity of any appraiser will be able to correct that problem. Because of the wide variety of problems and issues with these special kinds of property, each of them has their own special rule limited only to that specific kind of property. Clothing and household items typically cannot be deducted unless they are in, quote, good used condition or better. Requiring, quote, good used condition is intended to exclude worn out clothes. An exception to this rule is allowed if the donor is giving more than $500 of clothing and the donor includes a qualified appraisal of the clothing with the tax return. Thus, small donations of clothing in poor condition are not deductible. Large donations of such clothing may be deductible, but only if accompanied by a qualified appraisal. The same rule applies not only to clothing, but to other household items. The term household items does not include art, antiques, jewelry, or collections. Instead, it refers to items like furniture, electronics, appliances, linens, and the like. These household items may not be deducted unless they are in, quote, good used condition or better, or where the donation is accompanied by a qualified appraisal indicating a value in excess of $500 for the entire donation. In order to prevent abuse with contributions of automobiles, the special rule is that if the charity sells the automobile, the deduction may be no greater than the actual sales price. For example, suppose the donor paid $5,000 for a vehicle, in other words, basis, and it is currently worth $6,000, in other words, fair market value. The donor gives that vehicle to a charity and the charity sells it. Unfortunately, in this case, the charity does a poor job of pricing the vehicle. As a result, the vehicle sells for only $3,000. In that case, the donor can only deduct $3,000. This is true even though both the basis and the fair market value were higher than $3,000. This rule can only lower the charitable deduction from the amount that would normally result from the standard valuation rules for gifts of property. If, for example, two benefactors of the charity ran the bid for the vehicle up so that it sold for $10,000, the deduction for the contribution of the car would not be $10,000. As a gift of personal property not used by the charity, the deduction would still be the lower of fair market value or basis, which in this case is $5,000. The same rule applies not only to automobiles, but also to boats and even planes. However, the IRS does not require this reduction if the charitable deduction was $500 or less. Although it seems unlikely that automobiles, boats, or planes would commonly be worth $500 or less. An exception to this rule applies if the charity will actually use the vehicle in furtherance of its charitable purposes, or intends to give the vehicle to a needy person rather than to sell it. If the charity is willing to certify this usage on IRS Form 1098-C, then the donor can use the normal rules for valuing this gift of property, which in this case means following the rules for either short-term or long-term related use personal property. To address the problem of tax deduction financed safari trips, Congress limited deductions for taxidermy property to the cost of stuffing the animal only. Thus, none of the other costs of acquiring the animal may be deducted. Deducting charitable gifts of copyright or other intellectual property such as patents and trademarks is not simply a problem of fraud or abuse, but is fundamentally a problem of accurately valuing the property in advance. To resolve this issue, Congress allowed for the deduction of cost basis plus a share of the next 12 years of income from the intellectual property right. Thus, the full deduction does not come at the time of the initial transfer. Instead, the donor receives a stream of deductions over the next 12 years. In this way, the author giving a copyright to a charitable entity does not need to accurately predict its future value in advance, but instead can simply deduct a share of the actual dollars that go to the charity as a result of the gift. This deduction of the income stream is only available for gifts to public charities and not to private foundations. Note that, as in all other forms of charitable property deductions, the cost basis is deductible only if such basis is less than fair market value. Thus, conceptually, it may still be necessary to estimate the fair market value of an intellectual property right in advance. However, in practice, many such rights have little or no cost basis. For example, an author's cost basis would include only some paper and ink and would not take into account his or her time spent in producing the work. Note that time and effort are excluded from cost basis in other areas as well. For example, if a taxpayer purchases a dirty car for $5,000 and then spends 3 months cleaning and detailing it, his basis in the car is still only $5,000. Another exception to the standard valuation rules involves an unusual compromise on valuation. The normal rule for gifts of inventory is that only the cost basis of inventory is deductible. However, the tax code provides a special increase in the deduction for specific types of inventory gifts. If the donor is a standard corporation, known as a C corporation as opposed to the closely held S corporation, and is giving inventory to a public charity for the care of ill individuals, needy individuals, or infants, or it is giving qualified research materials to an institution of higher education or other scientific institution, then the donor C corporation can receive a higher deduction. This higher deduction will be the average of basis and fair market value. Thus, the corporation receives neither the most favored status, which would be fair market value, nor the less favored status, which would be cost basis, but instead receives something in the middle. However, this deduction is still limited to no more than double the cost basis in the gifted items. This is to prevent a scenario where the deduction was worth more than the cost of manufacturing the property. Although not exceptions to the general rules, some items can be hard to value, and consequently the IRS requires a special kind of valuation for these items. For example, in determining the fair market value of a used car, taxpayers must use the private party value and not the amount for which it would sell on a dealer lot. For boats, taxpayers may not estimate fair market value by simply looking at the price of boats of similar size and age. Instead, boats require an individual appraisal. This is because there can be dramatic differences in the value and seaworthiness of boats of the same age and size, making generic valuations less relevant. These rules help to prevent scenarios where it is more profitable to give the item of property than to sell the item of property. For example, if a donor had a boat that had significant issues with rotting or seaworthiness, its actual value may be only a fraction of what a boat in good condition of a similar size and age would sell for. If the donor was allowed to deduct a gift of the boat based upon the typical value of such boats of the same age and size, it could create a situation where the deduction was worth more than what the donor could sell the boat for. This is precisely the situation that tax policy wishes to avoid, and hence the reason for requiring individual appraisals for boats. Similarly, when valuing gifts of clothing, the valuation must be based upon what the used clothing would sell for in a consignment or thrift shop, not based upon what it sells for new in a retail environment. Of course, the difference between what an Armani suit sells for in an upscale retail environment and what a used Armani suit would sell for in a thrift shop is pretty dramatic. Finally, for gifts of large quantities of individual items, valuation must be based upon the value of the entire lot of items. It is not permitted to estimate the value of a single item and multiply that by the total number of items gifted. For example, suppose a donor found a box of 1,000 Beanie Babies on sale on eBay for $1,000. If the donor purchased these, then gave them to an orphanage over a year later for use in their charitable activities, the donor could be entitled to a deduction of fair market value. This is long-term capital gain, related use personal property. However, even if the fair market value for a single Beanie Baby toy was $5, the donor could not claim a fair market value for the gift of $5,000, that is $5 times 1,000 Beanie Babies. Instead, the fair market value would be the value of the entire lot of 1,000 such Beanie Babies sold as a single lot. This has been Valuing Gifts of Property, Part 3, Special Assets. Join us next time for Valuing Gifts of Property, Part 4, Penalties.